diversification in portfolios really has to do with mitigating volatility and giving investors the best and highest probability to provide steadier returns over time. Hey, everybody. Serge Berger here, your host of the Steady Wealth Podcast. As we're working through August here, and I always say August is the month when kind of the dead come back alive in terms of June and July being a pretty boring time for the markets in terms of people being absent, tend to come back at some point in August. Keep that in mind here as well. August is a binary month for the stock market. We can have really good things happen in terms of assets. They're slowly kind of pushing higher because no one cares and everyone's absent and volatility is just subdued because people are still just coming back from vacation. However, August can also be a month of great volatility. So keep that in mind. All else being equal, the month of August can be tricky because if a risk event happens, if news flow turns negative, people have to scramble back to the office and make decisions for their portfolios. I'm talking about institutional investors here, of course, primarily that are moving the market. So as it relates to today's topic, I wanted to revisit the idea of diversification. And usually when we talk about diversification, the self-directed trader tends to just kind of roll their eyes and go back and do some trading. However, there's a very sincere case to be made for diversifying not only a portfolio over time, but also for those people that are more proactive in terms of trading their accounts. I want to talk about diversification as a broad idea. And let me just read a couple of points here that I wrote down in terms of some of the reasons why I think diversification is important. One of those main reasons to me is really just has to do with, again, just being able to sleep at night. Let me go through that. I have a really cool chart I'm going to describe to you. Again, for those people that are watching this on YouTube, you will have the benefit of seeing the chart. Do not worry if you're listening to this on audio only. I will describe it just as well for you so you don't have to worry about missing anything. So first of all, let me just rattle through a couple of points on the case for diversification. And I should say here, as we are in the month of August, I'm seeing once again a lot of complacency. I'm seeing lots of investors kind of indifferent as to, or not indifferent, but they're not really caring too much about looking at their portfolio, looking at the markets, because things have done so well year to date. Mostly the tech indices, which is of course broadly also like the S&P 500 is a tech index, by the way. If you look at it broadly speaking in terms of its weighting. So first of all, diversification is an important tool due to risk mitigation. So diversification, the way I look at it, it reduces the impact of poor performance from a single investment to our overall portfolio. Furthermore, I wrote down, one of the reasons we want to spread our investments across different asset classes. This is also true for trading accounts, by the way. Different industries, geographical regions, maybe even. This can lower the risk of significant losses. So it's one of the reasons I always talk about, again, whether we're trading or investing, we do not want to be exposed to a single investment that can completely behead our portfolio. More stable returns is another thing I wrote down. I think a diversified portfolio, is really its design is to balance potential returns and risks. And this is where we're going to get to the chart. I'm going to show you something called a quilt chart. It's really fantastic. Some investments may experience volatility. Others can be more stable. So overall, it's going to help us smoothen our performance over time. So if you are listening right now and you don't know what your portfolio, your net worth is invested in terms of exposure to volatility, I would encourage you to go ahead and check that out. And what we found is that the average American investor, retiree, has, broadly speaking, and this is not being judgmental, just factually, has too much stocks. Some of that has to do because portfolios may not have been rebalanced. So the stock market has had such a big run over the past decade that some portfolios have gotten completely out of balance. And I've mentioned this before in this podcast. I've seen people's portfolios, retired people, baby boomers, 70, 75 years old, not the ones just getting retired, but ones well deep into retirement that have 85, 90+% stocks. That is in my humble opinion, and the way we look at the markets, just too much, right? You want to have diversified, especially right now where, the fixed income markets, T-bills can give us 5.5% risk free. So think about that in terms of asset allocation. So the other thing is, I think a diversified portfolio allows us to actually capitalize on opportunities. How so? Well, different assets perform well under varying market conditions and others don't. So diversification basically allows us to take advantage of growth opportunities across different sectors and markets, and thus reducing our sort of reliance on the performance of a single investment. So if you've ever missed out on an opportunity in, well, whatever, let's say Nvidia this year, right? That's the one everyone talks about still. Imagine having had no allocation at all to technology. So diversification is important because we never know exactly where the moves come from. We can only make a good guess. And if the move doesn't come there and in fact goes the opposite direction, but the one thing we're betting on a lot is somewhere else, then we've lost twice. We've not only then made the wrong bet in the one thing we did bet on, meaning it lost money, but we totally missed out on where the money was going. So diversification, really important, again, both from a trading perspective, but also really in referring to right now sort of the broader, our net worth, which for most people is tied up in investment accounts, sort of, in here in the United States, those are individual retirement accounts or through an employee as a 401k. In Europe, they have various different schemes based on countries, Canada, Latin America, Asia, so on and so forth, all have different kinds of things. The other thing is reducing volatility. And we see this a lot when people come to us, whether it's at the study trader, where people come to us to kind of get their own, want to do some of their money their own, meaning they want to invest a little bit or trade a little bit in their own. They get our research, access to our tools, our insights, videos, research reports, all sorts of stuff. And we see that the older people get, the more they're sensitive to volatility, particularly as they head towards retirement. And I understand a lot of people here might be in retirement, heading towards retirement, but there also going to be plenty of people here that are in their 30s, 20s, 30s, 40s, and early 50s, right, before they get into the late 50s, where diversification and reducing volatility may not necessarily be the one thing they want to do, but it does help because we're going to panic at the wrong moment. So reduced volatility is a function of proper diversification. When value of one asset declines, another one is going to probably do better if we're diversified. So this helps reduce the overall volatility of our investment returns. From a long-term perspective, and again, you can take this also from a trading perspective, diversification just encourages a longer-term perspective. It's going to align our principles of not putting all our eggs in one basket. It helps us stay invested through market fluctuations and hopefully ultimately potentially leads to a more consistent, sustainable growth over time. There's a really high probability, of course, of that happening. There's a real long-term track record on that. So having said that, let me walk you through, I think, what is an incredibly interesting chart for lots of people. And again, if you're not watching this on YouTube, if you're just listening to this, do not worry. You are not going to miss anything here. I'm just going to flip over the screen so everyone here on YouTube can watch this. Let me just give me just 1 second. Let me flip over. I'm going to show the window here. It's like the best way of doing it. And the window has this thing on it. So let me do that. Okay, perfect. So what we're looking at here, and I showed this in a presentation to clients this past week in full disclosure for the first time because I think people are now more willing to listen to stuff like this. This is something called a quilt chart, or at least some people refer to it. This is courtesy of JP Morgan. I grabbed it right off the website, off their public website that I found. And you can see it's up to date. If you look at the upper right-hand corner, this says you can see what the up to date. So let me describe what this is again. If you're not watching this on YouTube, let me describe. Promise you're not missing anything. So what this is, what we're showing right now is a chart of different asset classes. So imagine, I don't know how many there are, like 200 little squares on a screen, and each asset class is broken down by how much it made per year in that year. So right, we're looking at your returns per asset class from 2008 all the way through 2022 and year to date here in 2023. So the asset classes that are showcased here are large cap equities, small cap equities, real estate investment trusts, high yield bonds, fixed income, broadly speaking, developed market equities, emerging market equities, cash, and commodities. I know that's a mouthful, I should say, and a handful, but it's just a bunch of stuff. The point is, and those people that are seeing this, you can see every year, or in most years, the returns are completely mixed. Meaning, so for example, let me give you an example. So in 2020, small cap stocks, or let's say large cap stocks, because what everyone focuses on, large cap stocks in 2020 made 18%. They made 28% in 2021. In 22, they lost 18. So far, year to date, they're up 20. Let's talk about commodities. Commodities in 2020 were down 3%, up 27% in 2021, up 16 in 2022. This year, they're down 2, right? And so we can go through this in all sorts of different iterations. The point is, this part of the game, sector, group, asset class rotation, is something that there's plenty of investing and trading strategies that focus on this. From an asset allocation perspective, for 70, 80% of our net worth, timing the market this way is very, very, very difficult. And a lot of people that come to us and have tried to do this for long enough realize that ultimately, yes, they may want to do some of this. Try to figure out, hey, which horse is going to be the fastest one this year? Is it going to be large cap stocks? Maybe even which sector? Is it going to be energy stocks? Is it going to be utilities? Is it going to be whatever, right? That sector and group rotation, I personally, for me, and I can speak for our clients as well, I find that easier to do from a trading perspective. From an overall longer-term asset allocation perspective, I do think there are changes to be made, and we do changes to our asset allocation based on where we are in the economic cycle. But I think trying to micro time this is where lots of people really end up losing money. And we see this particularly in self-directed investors that, once they have a bit more time, and again, whether it's between jobs in their 30s, 40s, 50s, or once they start retiring, they think they can micro time every single penny of their own by micro timing and knowing exactly which asset class, which horse is going to be the fastest, which is the slowest this year, and so on and so forth. I'm here to tell you, over the past 25 years, 24, 20 years, as doing this full time, I find that a nearly impossible task to do with all our money. With some of it, yes. With some more proactive money we have, maybe that's 20%, maybe that's 30%, maybe it's 5% of our own personal net worth. It all depends on everyone's different, right? Or maybe even less than that. I think that's an honorable thing to try to do. However, the odds of it being successful over time is not very good. Meaning, if we do this with some money, we can be quite nimble. Most people are not willing to spend their entire net worth trying to be that nimble in the market. Again, in my humble opinion, I'm only speaking for myself and my experience for the past 24 years. I have yet to find someone who does this successfully with all their money. I have found plenty of people who do this okay with, again, a little part of their money, between 2, 5, 10, 20%, 30% at most. So the case for diversification, both from a trading perspective, but also from a longer-term perspective, is really serious, right? We want to make sure we diversify and we do this right. Now, this does not mean that let's assume I'm going to an extreme example, but let's assume, for example, that we get into a multi-year stretch. Like, for example, again, for those people that can see this, let's say we go into a multi-year stretch where commodities had down years, 4 years in a row. In 2012, they were down 1%, call that flat. In 2013, down 9.5%, 10%. 2014, down 17%, and almost down 25% in 2015. Now, those are multi-year malaises of commodities. That typically has to do with the rate of change in where we are in terms of the economic cycle. It can have a lot to do with commodities, what's the dollar doing, and so on and so forth. I have no problem making a call from a longer-term portfolio asset allocation to go underweight, let's say, commodities in a situation like that, because of it, and of course we never know when it ends. But usually, if something underperforms that dramatically for 4 years, it's because something significant changes. Now, when that changes, or maybe even if we're really good, we find out we make a change before it happens. There's no doubt that one can make changes for that. What I'm trying to say is, don't try to micro time the markets with the majority of our money. It is a losing strategy for the vast majority of investors, and I think it's something that we need to keep in mind. Again, I have seen more. I'm going to try to be careful how I say this. Most people, I'm going to say this, most people that I've come across, in fact, literally every single one of them that have come to me and said they're going to basically become traders with every single penny they own, have done very, very poorly, not only in absolute terms, um, not only in relative terms, meaning the broader market beat them hand over fist, and all they would have had to do is buy like the S&P 500 or have a very simple diversified portfolio, even better, much better actually, and that would have beat the living daylights out of their trying to microtime the market. Again, I'm not saying we don't do that with some of our money. That's certainly fine if someone wants to do that. I do it with some, it's part of our business model. We do that, and I like it with some of our money from a trading perspective. It gets really, really difficult, almost impossible if we do it long term. So the diversification case here is really, really important. I'm going to stop sharing the screen here and just get back to some of the other important, what I think are important points for cases for diversification. And I understand that we're coming out of a period here where markets, and I've said this many, many times, I mentioned almost every podcast episode, where markets essentially have just gone higher. And when I say markets, it's basically equities, right? For many investors that are more, growth oriented, equities have basically gone higher. So they see very little reason to diversify. However, what people forget is that markets are not made up of just 10 years of market history. Right now, we're coming out of a 12, 13-year period of equity markets going steeply higher, coming out of the GFC, the Great Financial Crisis, that ended more or less in 2009, going into 2010. And I think people forget that, yes, that's 12, 13 years ago, but 12, 13 years is a long period of time, but it's not the only history we have. I mean, we have a lot more history than that if you go back over time. So I think one of the things that's important here too is that when we look at, a diversified portfolio, the other thing it does, it hedges us against unpredictability. We don't know when things happen and come out of left field. So diversification kind of guards us against the uncertainty that comes with investing, whether that's economic, political, or, market events that can impact our individual investments. A diversified approach reduces the impact of any single event on our overall portfolio. And that's really, really important, I think, particularly where we are right now. And again, it almost doesn't matter what your age is or where you are in life. Diversification is really important. And again, I find it really difficult. It's become much easier now for the past few months, but I still find it very difficult for people to realize why they need a diversified portfolio, and maybe why professionals should be taking part of the majority of their money, not their trading account. That's a different story. By all means, have some guidance there, have some, what we do at the Study Trader, we help traders, do some of their own stuff. But I think there is a bit of I don't want to call it arrogance because that sounds derogatory, but just there's a bit of people are a bit too, are too convinced that of their abilities in the markets and being able to having made money over the past 10 years. Everyone I talk to, literally, I'm talking 10 out of 10. Every person I talk to refers to the past 10, 12 years. Every single one of them. No one talks to me about the past 20 years. And these are, people in their 50s, 60s, 70s. And, 10 years ago, none of them were not investing, right? So keep that in mind. I think the important thing here is also factual. So the potential for better risk-adjusted returns is factual. There are studies, just fact. Indeed, this has shown that diversified portfolios just deliver more consistency over the long term, not in any given month, quarter, or year, but over time. And this risk-adjusted approach can lead to better performance and just relative to a concentrated portfolio. So last point, and I think this, quite frankly, for a lot of people, particularly really of once they retire at the very latest, peace of mind. If you know that your investments are spread across various asset classes, it can provide a sense of security so you're not overly reliant on one stock. If you've ever been in a situation where you kind of bet the pony on one particular idea, whether it's a theme, a sector, a bond, a stock, and whatever, and you find yourself checking your phone, every half an hour what that thing is doing. Clearly, that's not fun. Clearly, that's not balanced, and clearly, there's a lot more risk that you're carrying with that trade than you would like to. So it can give us a sense of security. And this peace of mind can really help us stay focused on our financial objectives, without being overly influenced by short-term market fluctuations. So again, diversification offers us to take advantage of all sorts of things in the market, not just one pocket. Again, I'm not saying don't have a trading account where you can make, bets, concentrated bets. I'm all for that. What I am saying is let's not do that with most of our money. Hope it helps, folks. We'll see you again in the next Steady Wealth podcast. Be well. Again, be careful. It's August. August can come with all sorts of unexpected events. September, October. I'm on the fence right now whether I want to be very, very cautious or I want to remain cautiously optimistic. I'm still cautiously optimistic, but I'm very much open to tail risks happening this year. I think I've been too early on that call for sure. I've missed out the AI rally for the most part, not entirely. Managed to get a couple of clips here and there, but for the most part, I do think the broader economic picture is not as rosy as most economists have now all of a sudden agreed that it is when they were not on that page in January. So anyway, hope it makes sense, folks. SteadyWealthPodcast.com is where we post all these podcasts. Maybe you're listening on it right there, but share it with everyone. We'd love to see other people listen. If you want to be a guest on us, or you have something to say, if you have any, if you're a CEO or an individual investor, and you have a story to share, I want to invite you to come on as a guest. If you have if you're an analyst, investment banker, or hedge fund manager, whatever, right, or just have a story to tell about the markets, we'd love to have you on and share your experience and your thoughts with our audience. Until then, be well, and I'll talk to you soon.